Kia ora. Right, today we're going to go over property, plant and equipment, or otherwise known as PPE, one of those acronyms. Okay, there's an accounting standard for it. That's the NZIAS16. Okay, so pretty much it covers fixed assets, and the reason there's a standard around it is it's important that the users of the financial statements have a fair and true view of what the business investments are. Okay. So the key things are that the initial recognition of the assets costs, that could include freight and installation, and even some borrowing costs if those borrowing costs are incurred during the installation before the plant's actually in operation. Okay. You've covered depreciation previously, so that is just a provision, right? So it's an estimate of what the asset is wearing away each year. So just bear in mind, I suppose, that when there's accounting in the for larger organisations, they might have two sort of depreciation schedules, one for tax purposes and one for basically giving what they see as a true and fair view of the fixed assets, right? So the inland revenue does have a schedule of depreciation rates, and those are for tax purposes, right? So, but those should be a good reflection, really, of what things will wear and tear away, right? So, yeah, so you need to stick to the interest rates that the IRD subscribes for tax purposes, but to give your the user of the accounts a true view of the value of the assets, you might use a different type of method, right? So the IRD really only use either diminishing value or straight line, and yeah, you can end up, there's no sort of allowance for residual value and those sorts of things. Okay. All right, so the why is pretty straightforward. How? Okay, so there's a number of things in the standard. As I say, there's good guidelines there on what you need to include in the acquisition cost. Okay, so that's, and we've covered this in, you've covered this in previous papers as well. So it's getting the as I mentioned earlier, freight, some borrowing costs if they're incurred before the plant and equipment's up and running, installation costs, any of those sort of acquisition costs. Okay. Well, I've just talked about depreciation, so that's pretty straightforward. The main thing that we're building on here really is, okay, from time to time assets might not diminish in value as much as we have thought, or they might have diminished in value more than we had estimated, or there might be an event where assets are actually impaired. Okay, so the main thing we're going to focus on today is the revaluation of fixed assets. Okay, and that's the sort of type thing you can expect to see in the test. So I'm going to work through an example that's been in a previous test, and you'll get something similar. Okay, so this is practice exercise part A. Okay, so there's a company, it's got some buildings, and the book value as at the 31st of March 2019. So always key to pick up the right dates. So it's the end of the 19 year. The building account is 2 million, so that's what you paid for it. The accumulated depreciation is 400,000. So we'll have a book value of about, well, exactly 1.6 million, right? Then you've had a valuation done, and the valuation comes in the day after the year end. So this is a new financial year. Okay. The notes don't say what the year end is for this company, but let's just assume it's the 31st of March 2019. Okay, so the actual valuation is less than what you paid for it, but it's more than what you got as the book value. So the building hasn't depreciated as much as you would have expected, okay, which is a good thing. All right, so what you're required to do is to state the journal entries to account for the revaluation under the following methods. All right, so here we can explore two different methods of bringing that in. Okay, the net effect in the books is going to be the same. It's just slightly two different ways of doing it. So just become familiar with these two different ways of doing it, right? First one is A, which is we eliminate the accumulated depreciation against the gross carrying value. Okay. So we need to do some workings here for A, okay? So in this scenario, we're saying that the okay, there's the value of the building, and that's the depreciation, okay? Okay, so that gives us the book value, okay? So that's all well and good, okay? So the first thing we need to do is we need to get rid of that accumulated depreciation, right? So if we do a journal to get rid of that depreciation, we journal that depreciation, accumulated depreciation, sorry, into that building account, right? So to get rid of that, the journal would be 400,000 to that, would be debit, and it would be crediting the building account that amount, right? So we can do that journal, okay? I have put the accounts in here previously, just so you don't have to painfully watch me type in the names of the accounts. Okay, so here we go. So this is that journal I'm talking about. We're going to debit the depreciation account, accumulated depreciation account, sorry, for the building that. All right, okay. We'll just make it not so it's not negative, right? Okay, and the if I pick it up from the right place, it's probably better. Okay, and then if we credit the building account that amount, so that's eliminating. We've done it. We've eliminated the accumulated depreciation to the building account. Okay, so that really now would change the balance of this account. Okay, so the balance in the building account, once that journal's posted, would be 1.6 million. The balance of the accumulated depreciation account would now be 0. Okay, so that's part of the job done. Okay, what we also know is that the revaluation has come in at 1.8 million. Okay. Alright, so to get the right value in the building account, we're going to have to do a journal to increase that by 200,000. So we've just worked out that, I mean, that's pretty straightforward. You probably could have done that in your head. Okay, and so the journal will be debiting the building account. Okay, so we debit the building account. Okay, the 200,000. So now that the building account will have the correct balance. Okay, I could add another one there to show the closing balance, but we'll know that that is obviously going to be that plus that. So the correct valuation will be there. The other account which we credit, which will be a gain account, right? So what we know is if we make gains on the revaluation of property, plant and equipment, we show that in the statement of comprehensive income, or known as OCI. If you see OCI, we're talking about the statement of comprehensive income, right? So we're showing that as a gain, not up in the operating section, but down in the statement of comprehensive income, okay? So asset revaluation gain in the OCI will be the 2,000, right? Okay. Okay. All right. So that's good. So that could be just about job done, right, for that journal entry, right? There is another journal that basically we point out that when the accounts roll over to the next financial year, okay, so that's a year later, so that's presuming it's the 31st of March 2020 is the end of that year, rather than that being going directly to retained earnings, okay, rather than that going to retained earnings, you keep it separate in the equity section, right? So so that's just showing really where that figure there will go through to a revaluation reserve, right? So normally when you roll accounts over from one year to the other, the computer system automatically takes last year's profit and turns that into retained earnings, right? What we're saying is that the retained this part will not show as retained earnings. It shows as a separate reserve in the equity section, okay? Because you want to keep a track of that reserve. You don't want to hide that amongst retained earnings from operations, okay? As I say, those first two things there are really a job done, because normally in a automated accounting system, that rollover will automatically happen, right? It won't take, it'll have certain accounts that it'll know that they get rolled over into a separate section in the equity section, right? But if you do this journal, it just shows your understanding, right? So, okay, in the exam, I'll have some useful prompts, e.g. dates down the side or something like that, so that'll help you sort of remember, right? So it's really you understanding what you need to be doing, not so much rote learning stuff, right? Okay, I'll have the working set, you know, possibly with a header and maybe some column headings as well, just to sort of prompt you, but you need to find the figures to put them in, right? Okay. Obviously, people's workings can be different for every person who does it. Okay, this setup works for me. Okay, but you might have some other workings that work for you. As long as you understand what you're trying to achieve, obviously you can set up a table any way you like. As mentioned earlier, though, the more care you put in your setting up your workings table, the easier it is for you to understand where to get figures from, right? So from this one I could get my journal and my other journal. So that led me to my journals, right? Okay, so that's part A completed. Part B is we don't eliminate the accumulated depreciation. We just take the movement in the revaluation and prorata that to both the cost price and the accumulated depreciation. Okay, so we know that these figures are going to be the same as above, right? Okay, okay, which is good. Okay, now what percentage of buildings is it to the book value? Okay, so because the cost is more, okay, it's 100, it's 125%, okay, of that. Whereas this is obviously going to be minus 25%, okay, because it'll come to 100%. Okay, has to come to 100%. Okay, so that's a portion of the current book value. Okay, the revaluation, however, is 1.8 million. Okay, so what we're saying is, okay, the building should be 125% of the revaluation equals that. Let's try that. That times that. So it gets the same split, and the same apportionment to the valuation. Okay, and that should add up to the valuation. Yes, it does. Okay, so that's great. Okay, so what we've done is we've apportioned the revaluation pro rata over buildings and accumulated depreciation, which will give us our journal. So if the book value, not the book value, if the building cost is 2 mil and we've revalued up, we're going to have to increase that. That's a debit of 250. Okay, and we're going to also have to increase the amount of accumulated depreciation, right? Okay, so that'll give us the journal, right? So that's our journal to put in. Okay. Oops, wrong colour. Let's stick to that. I was just going to highlight my journals that I've done, which is good for me. Okay, all right. So this one here, the journal will be, and I've put the account names in here already. Okay, so building is going to be 250, so it's going to increase the value to 250. Okay, it's going to be, I'm going to increase the accumulated depreciation by 50,000, and I have got a gain. Again, that asset revaluation gain, it's exactly the same as up here, just a different way to get to it is that. Okay, so perfect. So that's the journal entry where we just pro rata the revaluation against what the current values in the asset and the accumulated depreciation account. So those are the two different methods, right? So you should be able to do this, okay? And then the next journal is exactly like the one above it, all right? So again, it's the same sort of thing, just drumming home the fact that we maintain that asset revaluation reserve separately in the equity statement, okay, from retained earnings, okay? Okay, so that's that one there. That's doing the two different ways, okay? Next practice exercise is still revaluations, all right? So a company purchased 2 items of plant and machinery on the 1st of October 2012. Okay, machine A and machine B. There's what they cost, 150 and 180. Estimated life is 10 years and 8 years. 10 years for machine A, 8 years for machine B. The residual value, so after 10 years, you should be able to get $25,000 for machine A. After 8 years, you should be able to get $30,000 for machine B. Right? Okay, so on the 1st of October 2015, which is 3 years later, okay, 13, 14, 15, so 3 years have passed. The directors decide to revalue the machines on the basis of an independent valuation that was made the day before. The valuations, machine A is 130,000 and machine B is 115,000. The useful lives and the residual value were considered to be the same as when the machine was purchased, meaning that machine A has 7 years left because there was 10 and now 3 years later, okay, so there's 7 to go, and the remaining residual stays the same. Machine B, okay, started off with 8, 3 years later we say that's still correct, so 3 years are gone, we've got 5 left, so there's a residual value of 30,000. On the 30th of September 2016, okay, both machines were depreciated based on the values. The company has a 30th of September balance date. You're required to show your workings and the journal entries to record the transactions for the revaluation. Okay, so there's two things, right? Revaluation, okay, of the on the 2nd of the October 2017. Okay, all right. We're going to use the elimination of accumulated depreciation method. Okay, so that was A above. All right. Okay. And then you're going to depreciate it on the 30th of September 2016 at the new revalued amount, okay? So you need, again, get your workings done so you know what to do for the journals. Okay, so there's a little bit of testing your depreciation calculation skills here, okay? So let's start off with the workings. So we know that the cost of machine A is 150, and we know that the cost of machine B is 180, so they were good with that, okay? We're told that it has got, machine A has got 10 years useful life with a residual of 250. So what that's going to be is it's going to be the 150 minus the residual, okay, divided by 10. Okay, so that's how much we're going to depreciate a year. So 10 of those is 125,000. And $25,000 left, okay, because that's what we're going to get back, all right? Okay, so the same goes for machine B. Machine B equals what it cost us, what we're going to get back at the end, Okay, so that's 150 grand we're going to have to write off over 8 years. Okay, I can just use that cell there, that's probably better. Okay, did I use the cell up there? No, I didn't. Okay, good to use cell references, but anyway. Okay, so that is the cost less the residual divided by how many years we're going to get useful life out of it. So those are the depreciation amounts per annum. Okay, so we've got 3 years worth of depreciation. So how much is accumulated? How much is accumulated? It's that times 3. Okay, and that one has depreciated the annual amount times 3. Okay, so that gives us that. Okay. All right, so what would the book value be at the end of September? It would be what we paid for it less what we've accumulated in depreciation. Okay, same goes for this one. So that would be their closing book values. Okay. Nobody's here. Shh. Yep, it's the dogs. Anyway, I'll try to go somewhere a little bit quieter until I work out nobody has arrived. Okay, so we've got up to the closing book values. All right. The next part is, okay, what's the revaluation? That's what we're trying to work out. We're trying to work this here out, right? Okay. It's the revaluation gain. Okay. So what is the carrying amount or the book value? We can pick that up from our workings just above. Okay. Right. And what is the fair value? Right. So that we go to the valuation. The valuation up here. Okay. The valuation up here tells us that the machine was 130. Okay, 130, 123, and that the 115 for machine B. Okay. Okay, so therefore, wow, it's worth more than we thought, more than the books show, sorry. Whereas the other ones on the other way around, it's actually the fair value is less than what the carrying value is, right? Book value, carrying value, the same thing, right? Okay, so you can see that one's, you know, got a better value, okay, and the one's got a lesser value. All right. Okay, so that's all good. Okay, so we could actually start doing our journals here because the next lot of workings really is for the other journal. Right, okay, so we're doing the elimination of accumulated depreciation. We know what our accumulated depreciation is because we worked it out up here, okay, and that gives us the journal. All right, so accumulated depreciation on machine A, we need to zero that out. Okay, accumulated depreciation account has a credit balance, so we need to debit it. Okay, the same goes for machine B. Okay, we need to, okay, and where do we put those to? We put those back to the main asset account, right? So machine A and machine B. Okay. All right, so that's how we do that. Okay. Eliminate depreciation to machine accounts. Okay. So that's step one. Cool. So the next thing we've got to do is we've got to acknowledge the gain. Okay, so we've all done that as well, right? Look at that. We've worked that out. So there's our two lots of workings, right? Okay, so we need to acknowledge that the machine A is actually worth more, so it's debit, which improves the balance. Okay, which is great. And that's a gain, so that goes to the OCI, Statement of Comprehensive Income. Okay, all right. And then there is on machine B though, there's going to be a loss, right? So that actually goes to the profit and loss. It goes in the operating section. So one of the parts of the accounting framework standards is that, you know, we need to be conservative. So therefore we recognise the increased wear and tear on that asset immediately in the P&L, whereas any gains on those sort of things we put to the area of statement, Statement of Comprehensive Income, right? So it's not showing us so much as the operational gain, right? Okay, so that's a loss, and it's going to be a loss of, I don't want to put it as a negative, right? So, because I'm already debiting, okay, because we know that's that, okay? And we know that we're going to have to reduce the machine account by that amount. Machine B, that is, all right? Okay, all right, so that's pretty much the first part of it done, okay? So we've revalued the machines using the elimination of accumulated depreciation method. Now the machines will show in the books at the fair value as per that valuation. So that's how we do the journal entry, okay? You could track the balances of those accounts, but I'm pretty sure you can see from these workings that I'm right there. Right. The next thing they ask us to do is to calculate the depreciation, right? Okay, so they ask us to calculate depreciation, right? So we now start depreciating the assets at what their value is, okay? And the value is the fair value, which is the valuation. Okay, cool. So it's 130,000 for machine A and 115,000 for machine B, right? That's as per the valuation, that's the fair value, all right? Okay, so how much depreciation do we calculate now, all right? So we know they still have a residual, so it's going to be the 130 less, the residual stays the same, right, at 25, okay, all right, okay, but we're going to have to spread that over, not 10 years now, only 7, okay, because there's only 7 years to run, so we divide that by 7, okay, so you can see that the depreciation is ramped up, which makes sense because we've now acknowledged that the machine is more valuable, okay, all right. The next one is we're going to say, right, what's the fair value of that? Machine B, the fair value, less the residual, which has stayed the same, which is 30,000. Okay, but now that's only got 5 years to run. Started with 8, 3 years have passed, 5 years to run. Okay, so divided by 5, and it gives us 17,000. So there's the two depreciations per annum that we now need to use, okay? And we can use those in the journal, okay? All right, so depreciation, you could add them together and just do one depreciation, all right, figure, but just to keep it sort of quite visible for you, it's all going to end up the same anyway. I'm just going to do them separately as well to post to the depreciation account, and the accounts I'm accrediting is the accumulated depreciation account for machine A and accumulated depreciation account for machine B. All right, and that's the depreciation for the year. All right, okay, so this is the sort of exercise that you'll need to be able to do during the exam. Okay, as I say, I'll have templates set up to a degree. Okay, I'll have it in. You can download the Excel while you're in the test, and you'll need to know what you're doing, obviously, to be able to fill in the workings and then to be able to actually do the journal, right? Okay, but for example, these working templates will be here with the headers, the right headers. They just won't have numbers in them. So you need to populate, plus you'll need to put in formulas, and plus you'll need to work out which figures you pick up to put in the journals, right? So for me, you know, I could work out which figures I needed to use for the journals in that one, also up here and here, right? Okay, so that's pretty much what you need to get up to speed with for property, plant and equipment, okay, bar for some questions in the multi-choice and all that sort of stuff around property, plant and equipment, right? But I'll do another sort of tutorial on sort of the type of questions you'll get in the multi-choice, okay? So I'll leave it at that. Have a good day, and I'll continue to post useful information.